channel. I'm Doris and I'm here to share with you about my stock account. Today my stock account has made a loss of $1,700. The stock market ended the Dow up 340 points on Thursday. Another doomsday predictions, recession, runaway inflation, and the debt crisis hit the US. In my account today, including the post market, I've made a total loss of 1,701, which is a loss of 2.12%. Right now, the net asset of my account is 78,000. SQQQ today decreased for 2.35% to 39.13, and DRV made a loss of 3.59% to 48.27. In the market today, market showed an overall gain with some industries showed a loss. The Dow Jones Industrial Average rose for 1.05% as a recovery from yesterday. Nasdaq made a gain of 0.73%, and S&P 500 made a gain of 0.76%. Today, the auto manufacturers industry made a loss of 2.65% due to the loss of Tesla, which is 5.85% today. Overall, the tech industries showed an overall gain. The market continues to focus on earnings, economic data, and inflation. The central bank said it would pause raising rates after midsummer, as the effects of previous increases could be seen this spring. The index was boosted by dovish comments from Fed officials. On Thursday, Atlanta Fed President Robert Bostic said the Fed could pause in raising interest rates after midsummer. He said he preferred to raise 25 basis points at the March policy meeting, but still watch the updated economic data. If the data is stronger than expected, it needs to adjust expectations of future interest rates. There's a long way to a price recovery. Bostic said he was firmly in the 25 basis point camp. By the spring, the effect of the previous policy should begin to show. He said caution is appropriate so that the Fed will do enough to control inflation without doing too much. Slow and steady policy changes should reduce the risk of a hard landing. Companies said they plan to slow the pace of employee wage growth, but still plan to increase hiring, Bostic said. The labor market needs a somewhat slowdown, but not a catastrophic slowdown. Bostic's remark helped U.S. stocks to overcome the negative effects of raising Treasury yields. On Thursday, the benchmark 10-year yield remained above 4%, with the 2-year yields were the highest in more than a decade. In recent days, rising Treasury yields and concerns that a Fed rate hike could rise more than expected have hurt investors and weakened the rally since early 2023. Cantor Fitzgerald company analyst Eric Johnston said you will enter a situation where if interest rates remain high, the PE ratio needs to increase, which could lead to further overall declines in the economy because of these lag effects. Then if the economy declines, corporate profits will continue to fall in the long term. On the economic data front Thursday, the labor market reported the initial claims of unemployment benefits in the week ended February 24th, or 190,000 compared with 195,000 expected and 192,000 previously. Continuing people receiving unemployment benefits for the week ended February 18th was 1.655 million versus 1.665 million expected versus 1.654 million previously. Another data showed that the final fourth quarter non-farm unit labor cost rose 3.2% from the previous quarter, compared with 1.6% expected and 1.1% previously. Average hourly earnings rose 4.9% month-to-month, much higher than market expectations. Final non-farm productivity for the fourth quarter is 1.7% versus 1.6% expected and 3% last. U.S. calls fell early last week and remained historically low, the latest sign of a tight labor market that most businesses are reluctant to fire workers, analysts said. The figures highlight the continued tension in the U.S. labor market, while a number of prominent companies Mainly tech and financial companies have announced layoffs in recent months. The number of layoffs across the economy has remained historically low. Still, economists and investors are watching the initial jobless claims data closely to see if there are signs that labor market tensions have begun to ease. Another doomsday predictions: recession, runaway inflation, and the debt crisis hit the U.S. Leading economist Norio Rubini, who accurately predicted the 2008 financial tsunami, was called the Doctor of Doom, said on Thursday that a perfect storm is brewing in 2023 and the market will be hit by the recession, debt crisis, and runaway inflation. Rubini was one of the first to predict the 2008 financial crisis, warning for months of a possible stagflation debt crisis that, combined with the 1970s stagflation, was the worst aspects of the 2008 debt crisis. "I do think there will be a stagflation crisis this year," he said in an interview. With inflation remaining at 6.4%, Rubini estimates the Fed need to raise its benchmark interest rates well above 6% to bring inflation back to its 2% target. But he added that it could trigger a severe recession, stock market crash, and a surge in debt defaults, leaving the Fed with no choice but to abandon its effort to fight inflation and put prices out of control. In any case, the outcome will be a severe recession, with more debt and inflation problems. Rubini warned, "Now we're facing a perfect storm: inflation, stagflation, recession, and a potential debt crisis." He remains extremely pessimistic about the U.S. economy, although many optimists in the market believe that U.S. can avoid a recession this year. In addition, for the rally earlier this year, Rubini warned that the benchmark index could fall another 30% as investors cope with the extreme macro environment. "They'll continue to fall," he said. One of the stock market noted that the market is already adjusting as investors digested the impact of the Fed rate hike. Finally, he urged the investors to protect themselves by choosing inflation hedging items such as gold, inflation-linked bonds, and short-term bonds. He said these options could outstrip stocks and bonds, which could both suffer under the new economy. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.